Today, we embark on a journey into the world of economics, where headlines like "The European Central Bank raises interest rates" spark both curiosity and concern. As I stand at the crossroads of global financial shifts and personal budgets, I invite you to explore what these changes mean on a day-to-day basis. Imagine reading the news and wondering how decisions made in distant boardrooms trickle down to affect your ability to finance a home or your savings growing in the bank. In this narrative, I will break down these powerful concepts into simple, relatable ideas. Together, we will uncover how increased borrowing costs, altered savings benefits, and a strategic battle against inflation shape our economy. This is not just about numbers and charts, but about your daily life, your future spending power, and the balance between risk and stability in modern financial planning. Let us begin this insightful exploration together. Let us now explore the basics behind interest rate adjustments, starting with the fundamental idea of borrowing costs. When the European Central Bank raises interest rates, it sets the stage for a chain reaction in the banking system. Banks, following this lead, raise the rates on the loans extended to consumers. Picture a family sitting together at a kitchen table, reviewing documents for a mortgage on a new home, as the increased rates shift their financial planning. The narrative unfolds to show that this rise in borrowing costs means higher monthly payments for a mortgage, car loan, or credit arrangements on credit cards. Each extra percentage point adds a tangible weight to the family's budgeting process. The simplicity of this concept lies in understanding that expensive loans discourage excessive borrowing, thereby maintaining a balance in the economy. As the costs of loans rise, households and businesses contemplate their spending decisions more carefully, inspiring a delayed or reduced purchase spirit. This chain reaction from central bank policy to personal finance illustrates how global economic strategies impact everyday financial choices. Thus, understanding these foundational mechanisms not only demystifies banking practices, but also empowers individuals to navigate their financial futures with greater confidence. As the narrative shifts, consider the silver lining for those who save their money. The rise in interest rates often benefits savings accounts, where higher returns can gradually build a stronger financial cushion over time. Picture a scene where a young professional, after carefully reviewing his bank app, notices that the interest earned on his savings has increased, signaling a small but promising boost to his future financial plans. In this unfolding story, the dual nature of rate hikes comes to light. While borrowing becomes more expensive, the rewards for setting money aside grow steadily. This balance encourages a conservative approach to spending, prompting individuals to view their savings account as both a safe haven and a growing resource. The narrative gently assures that even in times of economic tightening, the opportunity for financial growth through savings remains a practical and sometimes unexpected benefit. A secure future shines brightly ahead. In the next chapter of our story, the focus turns to prices and inflation, two sides of the same economic coin. The primary objective behind raising interest rates is to tame inflation, the consistent rise in prices for everyday goods and services. Visualize a busy marketplace where the cost of groceries, clothing, and utilities escalates, putting pressure on household budgets. The decision by the ECB, portrayed as a cautious guardian of the economy, aims to slow down this upward trend. By making loans more expensive, the rate hike reduces consumer spending, causing a deliberate cooling effect on the economy. As shops adjust to this slower pace, price increases start to level off. In this economic narrative, the interplay between reduced spending and controlled inflation becomes evident. The story is one of balance, a countermeasure where increased financial caution helps stabilize prices over time. Understanding this dynamic not only highlights the rationale behind the policy, but also reassures us that despite short-term adjustments, there is a long-term strategy aimed at maintaining economic stability and protecting the purchasing power of everyday individuals. This deliberate policy move serves as a reminder that careful economic regulation benefits society as a whole, indeed. Turning our focus to everyday effects, consider how these economic shifts transform the practical aspects of life. Rising interest rates lead to more costly loans and mortgages, impacting monthly budgets and long-term financial planning. Conversely, the improved returns on savings accounts can offer a comforting boost for prudent savers. This narrative ties together the overall impact of central bank decisions on everyday living, reinforcing that while financial adjustments can pose challenges, they also create opportunities for stability and growth. The balance between higher expenses and improved savings is a subtle yet powerful story unfolding in everyday financial choices. Take notice. In closing, this narrative reveals how major financial decisions resonate in our daily lives. The ECB's rate hikes affect loan costs, enhance savings returns, and promote price stability. Grasp these insights to navigate your personal finances. Stay informed and empowered as you watch your future unfold. Knowledge builds lasting confidence.